everybody, and welcome to the webinar today. We are here. We're talking about everyday funding, and we have a new project that we want to get more people involved with. I also have joining with me today is my good friend Bobby and co-host.
Hello, how's it going?
So Bobby Patterson, everybody. So Bobby has been very influential in working with me on the Chase Apartments. Okay, so along with finding properties and funding of deals, we also like to offer to our members opportunities to invest in deals. So a lot of times people will come to us and say, I have this deal that's that we need to fund, and it's a little difficult. So we thought today we would show you how to fund an apartment complex, how we did the funding, and the uniqueness on how it was done, and if you'd like to participate, you can do that. Does that sound good, everybody?
Sounds good to me.
Sounds good to Bobby, right? All right, so let's start, okay? Maybe some of you have heard about this property, maybe you haven't. Bobby, are you on the screen at all?
I think I am when we move far enough back.
Okay, then we're both in.
Yeah, there we go.
Okay. So the Chase Apartments. The Chase Apartments, do you know where they're located?
They are in Anderson, Indiana.
They are.
And that is a suburb outside of Indianapolis, about 30 minutes away. It's your typical working class area. Apartment prices are very nice compared to here on Long Island.
Right. So I think the first lesson that a lot of people should learn is that when looking at properties, not to be afraid to go outside their comfort zone. Okay?
That's the only place to find new opportunities, really. If you keep doing the same thing and you're not succeeding at it fully, then it's just going to keep on happening.
Right. Well, market changes happen all the time. So in the tri-state area, New York, New Jersey, Connecticut, it is getting harder to find these deals, right?
Absolutely.
So this happens to be brought to us by one of our sponsors. A sponsor is a real estate developer who has experience in finding and fixing and flipping these deals. Now, a lot of people ask me, how do I get into apartment buildings? You know, how do I do my first deal? And I would tell you the first way to do it is invest in somebody who's more experienced and latch into their knowledge and expertise and see how a deal is supposed to go. Learn from their hurdles, because inevitably every project will have some kind of hiccups to it. All right, so it's really important that you understand how to deal with those hiccups. And if you're coming from the single family world,
yes,
right, and transitioning over, it's more important that you work with somebody who's experienced in dealing with that. Okay, so let's start with the Chase Apartments. Okay, this is a brief breakdown, and Bobby's going to help me with that because I don't have to. All right, so here's a brief summary of it. Bobby, you want to start just giving like how many units and what the mix is?
Sure thing.
You know?
So the Chase Apartment highlights here, we've got a 36-unit multifamily complex. That's approximately 36,000 square feet. It's 2.32 acres. 44% of the units are occupied at below market rate with month-to-month leases. The upside, by completing renovations on this property and a lease up at market rent, will increase value and increase our selling point as well.
So this is pretty much just a basic summary, right? So it's 36 units. It's actually comprised of 5 separate buildings, which is kind of unique. It gives us the opportunity to fix and flip one building at a time and lease up, okay? This is a bigger BRRRR method. It's what we've been talking about for the last couple of webinars. It's also what we have an event on. January 19th and 20th. We want to put that out there for you guys.
Also, this January 8th general meeting is going to be on BRRRR.
Right. So next Tuesday night, we're going to be talking about not only the project, how to do the BRRRR method, and then we're going to follow up with a workshop class where you're actually working on projects, and that's on the 2-day event. So if you want more information, look at our email blast. We'll be sending them out, okay? And if you'd like to sign up, just call our office or email Bobby, okay? So let's break this down a little bit. The sponsor worked very diligently in finding a property in this area. Now, why did he pick Anderson, Indiana? What is Anderson, Indiana? It's pretty much not a sexy place, right? So that's the key, guys. Work for something that has a steady any kind of climate, economic climate. You want to make sure that it's not on a declining. If it's on a rebound inclining, slightly inclining, but where it has stability. And you also want to make sure you're looking at apartment complexes that are in the low IC areas. When you talk about A, B, C, D territories, D is deeply distressed and don't invest.
So simple.
Yeah, C is for cash flow, C is for better neighborhood, and A for A+ premium areas where you're not going to see great returns, but you don't have as many maintenance issues. The reason why you have bigger cash flows in the C area is because they're generally older properties. They're usually in the 70s and 80s they were built, and they're being renovated. So this is just a larger fix and flip. That's all it is. And so the purchase price for all 36 units is very inexpensive at $650,000. A lot of people ask, like, how do you find these deals? And maybe you could tell the story about Dylan and how he found this property.
Well, Dylan found this property from doing a very similar property near there called Park on 9th. Was the name of it? Park with a Q. On 8th, I'm sorry. Park on 8th, Park with a Q, not a K. And he found great success in this. He actually went to, and I found this really impressive, if you listen to our webinars, if you listen to our podcasts, we had him on as a guest about a month ago, and he went into great detail about how he went through schooling for this. He actually found a college that had real estate courses and stuck with it. Didn't know exactly what he wanted to do in real estate, but he found his niche, and his niche is multifamily apartment complexes.
Yeah, so this is now his 6th project that he's going to be doing. And basically, he oversees the purchase of the acquisition price, the rehab. He's more of a hands-on coordinating for the rehab. And so the interesting story I found about this is that he was doing, yes, he was doing the renovation on Park on 8th, but his property management company told him about this property because they were managing it, and they saw that the landlord was not as responsive. And so just to give a FYI tip, if you're looking for deals, check with property management companies. A lot of you guys spend a lot of time, spending marketing money, but building relationships with local property managers could get you either a single family, multifamily, or in this case, an apartment complex. Okay, so that would be my first tip of today is. Well, second tip, right? First is don't be afraid to go outside your area.
Right.
Second would be look for property management companies as a way of getting into a project. All right, so let's look at it. The renovation cost is $735. We'll see it on the next slide what that breaks down to. Closing costs are a little bit higher on these projects. They're about $50,000, and that includes the financing closing costs that we have, okay? The deal cost is $1.435, okay? What we need to raise as far as capital is $700,000. And just to note that $700,000 includes cash reserve for the interest reserve. So that means that the financing company is going to collect at closing 12 months of monthly payments for the project. So even though we could use it from cash flow, they're not going to take it performing. They're going to require us to press, okay? And then it's also going to require an additional, we will be negatively cash flowing for the first few months, so they want to make sure that we have our negative cash flow and any contingency also in an escrow. So that will be another $75,000. So even though we have to raise $700,000, $150,000 of it is actual profit being, not profit, but escrow money. So that will come back to the investors. We're purchasing at about $18 a square foot. And interestingly, the loan amount we got is $1,050,000, and we estimate this project to be about 18 months long, right? So let me break that down because somebody looking at this might have this question: why is the total deal cost $1.435, and we have a loan for $1 million, and we have $700 required? So isn't that more than the deal request? So what was one of the reasons I just said that was why we have to overfund it?
Oh, it's going to be the $150,000 in escrow for two separate reasons.
Correct. So just count on that. And then the other thing is that they're going to take out some additional fees on top of that in their loan, but it's rolled up into the loan amount. All right. But our projected profit, even after the loan and the higher interest rate, is going to be about $292,000 for the whole project. We have a pref that's called the preferred rate of return. And do you know what the preferred rate on this project is?
This was 8%?
This was 8%, right. So what it does is the first 5% goes to the investors, the other 3% goes to our company, and we get that on the back end. And then after, do you remember what the split is between the investor and the sponsors?
Oh, was that 50-50? Yeah.
So on top of the preferred rate of return of 5%, after that 8%, they're going to split the profit 50% to the investors. So the projected net return would be $146,000. Okay, just so you guys know, which averages out to be an IRR of about 17%. Okay, that's pretty high, and especially if you're more of a limited liability partner. Okay. So if you're interested in investing, because you'll learn and earn with this program, is $25,000 increments. So you can invest as little as $25,000 up to we already have committed funds to $300,000. So the maximum at this point is $400,000. Okay. We're looking to close the end of this month. Due diligence was done. And we do have our estimated rehab expenses in there, and we'll detail that on the next page, okay? So I just want you to understand that the other difference of profit, because if you take the resale price minus what the loan amount and cost of the deal is, it doesn't equal that amount, and the additional amount is our projected cash flow, okay? So everybody understands. I had that question brought up, so I figured I'd address it while we're here, okay? All right, so let's break this down. You want to give how the unit mix works and what type of amenities they have and when it was built?
Sure thing. So we've got a mixture of units here. We've got 1 bedroom, 1 baths, and 2 bedroom, 1 baths. The 1 bed, 1 baths are 7 units in total. 2 bed, 1 baths are 29 units, totaling 36 altogether. It is in 5 separate 2-story buildings. The square footage, 35,824, or about 2.32 acres. It was built in 1972. There are plus or minus just about 54 parking spaces, leasing office on site, as well as laundry facilities and park area.
Okay, so there's a couple of things you want to look at when you're looking at analyzing a property, and one is unit mix. So typically, if you're renting to blue-collar working families, which this is...
Yeah, Anderson has a lot of them,
right.
Hard-working Americans.
Right, exactly. Their unit mix is between 7... so 7 of those units are the 1 bedroom and 29 are the 2. And that's the right proportion of ratio, right? You want it to be less than 30% in the 1 bedrooms and the rest in 2 and 3 bedrooms. Why do you think that is?
Because less of the population in there is going to be requiring only 1 bedroom. That's just going to be probably some single workers or maybe unfortunately very low-income families that have to share a room with their child or something like that. But for the majority of them, of the working class that'll be there from, and you'll see in the next slide, I believe, just exactly what factories and stuff are around there. That'll be for families. 2 bedrooms, 1 bathroom. It's a great startup for a family.
Excellent. And it's also, so it's higher demand, right? Mm-hmm. So the better demand is for the 2-bedroom units. Also, what you'll find is less turnover. And turnover is so important because it's so costly. So the least amount of turnovers, that's when somebody moves out and somebody moves in. So what typically happens is a couple starts out with 1 or a single person, then they bring the girlfriend, boyfriend, whatever, and then lo and behold, another kid comes along. Maybe they'll stay in the 1 bedroom. It's tight, but by the time the second kid comes, they really got to get this.
Or even by the time the kid's, I'd say 2 or 3.
Yeah.
Have his own bedroom.
Exactly. So it's good if they can move up and if you have a place for them to move up. So that's the benefit. but typically what's going to happen is they're going to move out. So that's why you want to make sure that you have more 2s and 3s in that population and area. This is very different in the urban communities. So everything I just said about that is working class, blue-collar American workers. This is not populations where SROs work really good. Those are single resident occupancy. Those work really good for homeless shelters and VA homes and disability living. And it wouldn't work really good in like Manhattan, stuff like that. There's like, you know, urban cities like that. It's definitely different demographics. So please don't apply that to that. And then we have these 2, oh, you can't hear us? Oh, you can't hear me. Thank you, Sasha, for saying that. Can you hear me better, Sasha?
Is there anyone else that can't hear us? I'm just going to take this time to check.
Yeah, you were just breaking up a little bit when you were discussing the urban.
Okay. Thank you, Khalid.
Okay. Thank you, Khalid. Okay.
Nope.
All right. So we'll
No problem.
Sorry about that. We want to make this available. So, Sasha, if you didn't hear anything, what we can do is also give you a copy of the recording as well.
Awesome.
So you can have the information. But that's important. So if anybody has questions during this, please feel free to email as well, okay? So just getting back to this with the apartment and financing, okay? So he had completed 5 transactions prior to this one, and now this is the track record of the sponsor, okay? This was their gross IRR. That means the total amount realized on the property before the split with the sponsors and the investors, okay? And it's typical that it's usually 50-50, 60-40, if there's a preferred rate of return like we have right now. Otherwise, some places will do it 70-30, 60-40. So it's all what you negotiate was the best for the investors, okay? So let me just explain a little bit about the underlying financing. I just want to go back to the last page because we have to do what's called a scope of work. Now this is regardless whether you're doing a single family house, 2-family, 3-family, 4-family, or a multifamily. If you are doing what's called a rehab loan or a construction loan, you need to have your purchase price and an itemized, detailed scope of work. Now this is a, what do you call those, like 10,000 view scope of work here.
View.
Yeah, thank you. This is just the basics of what's being done. We have an Excel sheet itemized down on exact costs on these. And so they're planning to do a resale and restriping of the parking lot. They're gonna, they have some landscaping they need to do on the property. Right now there's no drainage defects that they're looking at. The wood frame and brick facade is, so it has wood frame but then the brick looking type of project. Exterior, right. The roof was repaired in 2018, so we don't have any major repairs to it. They're typically flat roofs, which really are a pain in the buttocks, but flat roofs tend to leak more than your A-frame roofs, but on multifamily in the 70s and 80s, that's typically how they were built, and it's not cost effective to reframe them. Exterior windows, there's no known defects. Basically, the nice part about this is it's so much of the cosmetic stuff and not so much of the interior stuff. So you were talking about Park on 8th. They're a project that they have 3 blocks away from this one.
Right.
What kind of renovation did they do there? Do you remember?
That one, I think they had to do quite a bit more than just the looks of things. I believe that when they had to run new plumbing in and run new electrical wires, and it was definitely more of a big ordeal than this one will be. This one will definitely be going by a lot easier, especially with the same people that did a much larger, more comprehensive rehab not that far away being in charge of this.
Yeah, that was a multi-million-dollar renovation because they had to take it down to studs and back.
Yeah.
Right? And when they took it down to studs, I want you guys to understand this also. So this would be another point, especially when you're looking at scope of work. In the project they did just 3 blocks away, they wound up taking out all the gas, removing all the gas from it and putting it all electric. Now, again, that's indicative of an area. Could you imagine putting in the Northeast all electric heating?
Oh my God, it would be the worst.
Right, right. Just because of our cost of expense to do that would be so much more. So, but it makes sense there because their electric is so much more efficient, energy efficient, and cost efficient.
I believe they're in an energy deregulated market, which allows, like how we have just PSE&G or just the gas company to deal with here. You have multiple choices in your electric provider and your gas provider in states outside of New York, really. Those are called decentralized markets, and they give people the opportunity to save quite a bit of money, especially property owners looking to do large amounts of energy, looking to use large amounts of energy.
So two things they did on that renovation that they're not going to be doing on this one is, one, they ripped out the gas because it was more cost effective for them to take out the gas, and it limits for their tenants to just have 2 utilities. They put in a water system, so that was the second utility they put in. They sub-metered at each unit for their water usage. So they added the water bill but took the electric away. The water, again, being very inexpensive down there. It's water and sewer, so now that's a true pass-on to the tenants, and there's one less utility that they have to worry about, okay? They were still being billed for water. It just wasn't an actual fair system. It was a RUB system, so it's based on an average square footage. This will be based on their usage. All right, so then we have, with this particular property, because it's cosmetic, there's no need to go in there and take out the gas system and put all electric. So they're going to have the gas, electric, and they're going to be using the RUB system for this particular property. It's just more cost effective. So don't go through hard rules. That would be my third point. Don't go through hard rules. Do what's ordinary and custom, which is going to be more efficient, electric-wise or utility-wise, to keep your tenant. Okay. Remember, turnover is where you want to minimize. Okay. So between the exterior and the interior, the redevelopment cost is about $735,000. It's interesting to note there's only 6 properties that need, 6 units that need a full rehab, and then the rest are cosmetic. When I say cosmetic, what are we talking about?
Just an update, not having the old white appliances anymore, bringing them a dishwasher, microwave if they're not included in there. Probably stainless steel, not the highest quality, but better looking, something that will attract more people to lease up.
Yeah, actually we use black appliances because black stainless steel is not, it's a lot more cost, and it looks dirtier when they mess it up, whereas the black will hold its value better. But we're talking more like paint, carpet, maybe replace or refinish a cabinet, not replace a whole kitchen cabinets and stuff like that. But yes, updating utilities, appliances. All right, so now let's go into the track record. When funding any project, again, single-family house to multifamily to 2, 3, or 4 family units, track record is everything. Everybody thinks it's a credit score and how much assets you have in a bank, but that really is pale in comparison to your ability to finish a project,
right.
Okay? Especially this type. So I'm really proud to let you guys know about this particular project. We were able to get what's called non-recourse funding, right? So that's huge. So Bobby, can you explain to everybody what the difference between non-recourse and personal guarantee is? Or recourse?
Well, the non-recourse doesn't require a personal guarantee, correct?
Right. So that's huge, okay? Not because you think you'll default, but it's, when this is a business, you need to minimize as much risk as you can. So on this particular one, we were able to get a non-recourse loan for the individual, for the group. It was based on experience. So they had to show experience in order to get that non-recourse loan. They also had to pledge the asset to them, which that shouldn't be a problem, so it minimizes any foreclosure procedures. And it also, we're bringing some skin to the table, which is the $700,000, right? All right, so let's look at their track record. Like I was touching on before we went back to the other screen, is that they've completed 3 transactions and their gross IRR was before they split it, okay? Now let's look into the area. Remember we said with blue-collar families and workers, you want to make sure that you're looking at key factors like employers, okay? And so the biggest employer that they have there is actually Nestle, yes, the chocolate factory. They make those drinks, the Nestle.
They make so much actually worldwide. They are like they're near $1 trillion company worldwide.
Really?
Yeah, Nestle's huge.
I did not know that. So this area is home to Nestle, so the majority of the people work there. Stable rent is stable growth. The rent vacancy factor is less than 5% in this area, so this makes it an ideal area. Okay, you also have the Indy 500 there. There's also some other jobs in healthcare. I like that they have a little bit of a diversified employment base. So you've got a few different
job sectors there.
Yeah, exactly. Because that if one area goes down, you don't want all of them going down.
This isn't coal country. It is a good amount of stuff here.
So feel free to look through the demographics to see why we chose this area. Key thing is the rentals, right? So the subject rents for the one bedrooms are $625 based on comps. They actually price out higher, but we underwrote the project at $625. The second one is the comps for the 2 bedrooms. Again, we underwrote it at $675, but easily I believe we can get $700. The one benefit is as they're leasing on Park Avenue, any overflow will go over to this property.
Right.
And the deal is not to do all 5 at the same time. It's to do one building, lease it up, start on the next building, lease it up, and continue on. All right, this is a little bit of map of the area, but like we said, Park on 8th, which the sponsors are in the middle of finishing up, they have about 60 of the 94 units already leased up. They've done the renovation already, and they're ready to put that on the market. That's only 3 blocks away. Okay, so that makes it very easy for them to comp. We're going to be selling it at an 8 and we underwrote it at selling at an 8 cap. That would be a sales price of about 1.835, and that's using an expense ratio of 45%. Okay, that means that of the gross income. Okay, so all the potential gross income, meaning 7 units at $625 and 29 at $675, that gross income times that by divided by 45%, that's the expense ratio, or times it by the expense ratio is 45%. Subtract that off, and that's how much the NOI is, the net operating income, and we would sell that at an 8 cap. So if you times that by 8.0%, that would give you your purchase price, your resale price, okay? So I'm going to open it up to any questions at this point, if anybody has any questions. But if you're sitting on capital and you're waiting for your next deal and you don't know how to get it started, perhaps this is a good one to start getting investing in. The reason why is because you'll learn and earn, and you may skip the category of going into the fix and flip on the single family arena and go right into multifamily, small multifamily. All right? I've seen a lot of investors do it, and they've gotten very successful at it. All right, so a couple of things in recap. I just want to let you know on the financing. So while it was non-recourse, they will only lend 60% of the after repair value or 80% of the loan to cost. So that 1.435, they're only lending 80% of that, or 60% of the after repair value, whichever is less, okay? And that's how we got the 1.05, okay? And we were able to build in some costs into it. All right. The other thing is, just in summary, I would tell you, as a new year, be open-minded to investing in different marketplaces, also different asset classes, not just single family. Look at small multifamily. If you're sitting on capital, this is a great project to get into and learn and earn. You'll see how the financing works. You'll see how all the project updates are doing. The other benefit is look for projects that have good unit mix. That means lower on the single family, the one bedrooms, and more on the 2 and 3s. The reason being is less turnover. Less turnover means more profit because it's more costly to the property to have turnover. And you also want to invest in areas that have stable markets. Okay? So I hope this summary helps you guys on Webinar Wednesdays. I thank you all for joining. For myself and for Bobby. We're going to sign off, but feel free to email us. And we have this recorded. We'll send it out to everybody who is on this webinar. And if you'd like to invest, just call our office and we'll get you going on it, right?
All right, yeah, just call us up. We'll set up a phone call for you to have like an actual meeting with. We can even do an in-person meeting. Other than that, really just want to remind you guys this Tuesday the 8th is going to be our general meeting for January. It's nice and early this month, and so you should come out to that. That's on the bird topic again. Following that, the 19th and 20th of the month, we do have that 2-day event, and you do have to pre-register for it. We will not be taking anything at the door. It's going to fill up real fast, and we need pre-commitments done for it. So that is, to anybody who's a member here, members of LIREA are going to get a discounted price of only $179, and continuing or past students are going to get a discounted rate of only $159. Normally it would be $199 if you're not. That includes lunch for both days as well. It's at a hotel here in Hauppauge at the Radisson. And we really hope to see you guys there and hope at least to see you guys on Tuesday night. Okay, and if anybody's in the area, we're also doing our free orientation meeting tonight. That is for those that are interested in becoming a Long Island REIA member and finding out the benefits that you have, okay? And that is Delphi University, 55 Kennedy Drive. Address is Smithtown, but it's really in Hauppauge, right off of Motor Parkway. All right. So signing off, and Happy New Year. Happy New Year, everyone. Melissa. And Bobby. Bye. Bye-bye.